Hey, yo, it is Thursday, September 18th. This is episode 68 of the Deep and Connected live stream. Guys, the macro stuff we're going to cover today. I went through, I watched the entire speech from Jerome Powell yesterday from the FOMC meeting. I'm going to break down my main takeaways from that, what we can expect for the rest of the year as far as rate cuts go. Some interesting questions and answers there. So I went through and edited out the main takeaways there. We're also going to get into what's happening with Solana, the broader crypto markets, but looking at the digital asset treasuries versus the spot ETFs. There's some rule changes that the SEC dropped late yesterday that could speed track the upcoming spot ETFs. That could be a massive catalyst and change the timeline, because the big question was, are they waiting for the Clarity Act to pass? This could be a workaround where those spot ETFs come a lot sooner. So that'd obviously be massive. The other thing we're going to talk about in the deep end side of things, we talked a little bit yesterday, but we're going to dig further into the robotics section and talk about why I think that's going to be a big winner in the coming months. And also a new ETF application that I happened to find around alt season. So we're going to talk about that too. Hopefully everyone's having a wonderful evening. At the top of the hour, the next hour, we will be on the Deep End Happy Hour. So you guys should definitely hop over there after we finish up here. So a lot of stuff to cover, a lot of alpha to cover. Very exciting times, guys. But I don't know if you all saw this. Meta had their big AI demo today. Did not go particularly well.
You can make a Korean-inspired steak sauce using soy sauce, sesame oil.
What do I do first? What do I do first?
You've already combined the base ingredients, so now grate a pear to add to the sauce.
What do I do first?
You've already combined the base ingredients, so now grate the pear and gently combine it with the base sauce.
All right, I think the Wi-Fi might be messed up. Sorry, back to you, Mark.
It's all good. You know what? It's all good.
It's all good.
The irony of the whole thing is that you spend years making technology, and then the Wi-Fi at the day kind of catches you.
Well, it's reminiscent, if you guys remember, of when it was Elon and he's doing the demo of the Cybertruck, and it broke the window when it was not supposed to be able to be broken. They also had another demo. I'm not going to spend any more time on this, but they had another demo that failed. You know, they're spending billions of dollars and hundreds of millions of dollars poaching employees. Obviously not how they wanted that to go. I have a feeling, though. I have a feeling that Meta will figure it out. Just like any emerging technology, you know, you're going to have some bumps in the road, guys. But let's get over to the major macro side of things. We're gonna play the major parts of Jerome Powell's speech yesterday. I think there's some big takeaways from this and what we can expect. Obviously, it's going to have a huge impact on markets looking forward. So let's go ahead and start this off. The first thing he talks about is unemployment, and it's going to give us a gauge here on what type of unemployment they're expecting at the end of the year.
The downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
So 4.5% on the unemployment is what they're expecting. Obviously, the most recent reading had us at 4.3%. So they are expecting unemployment to get slightly worse. Of course, if we start to see numbers that tick up over and above that, that could give them more room for more aggressive cuts through the end of this year. Of course, there's 2 more meetings this year. We'll talk more about that because he does give us guidance on what we can expect as far as how many more rate cuts this year.
The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027.
So on that, they're expecting PCE measure of inflation to hit 3% by the end of this year. The most recent reading we had there is 2.6%. So they are still expecting inflation to go higher. Of course, the next reading is coming up in about a week. So I would imagine we will see that all over your X timeline when those results come out. So really the two main takeaways there, guys. If inflation starts to come in lower than expected, we can expect probably more rate cuts. If the job market starts to get weaker, we know what that means. It means that we could see more aggressive rate cuts. So at least we know what they're expecting. And as the numbers come in, we can kind of assess the situation and what to expect as far as rate cuts go.
To push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027.
Okay, so that would indicate 2 more rate cuts this year. Oh, he does go on to say this is an extra quarter point.
This path is 1/4 percentage point lower than projected in June.
Okay, so again, that would mean that as of right now, they are projecting a rate cut in the next 2 meetings. So that would be another rate cut in just over a month from now, October 28th and 29th. That would also be another cut roughly a month and a half after that in December. So that is what they're expecting right now. That's the median guidance as far as what we can expect the rest of this year. Polymarket, as you can see, is saying similar things right now. This is for October, the upcoming FOMC meeting. This is the next one that will be coming up. You can see a huge tick up following this meeting, up to 84% on a quarter point, an additional 4% for 50. So 88% now that there's at least one cut. And then looking at December, we're seeing obviously an increase there as well. So 2 more rate cuts this year at least, guys. We also now know what they're expecting as far as unemployment and inflation, and we can start measuring up against those. A couple other questions I thought were interesting. This guy talks about, asks him about, well, there's that missing job, the missing jobs, 911,000 job revision over the last year. Would you have cut sooner if you had known that you had bad data?
For the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
You know, we have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
In other words, yes. Yes, they would have cut sooner. Yeah, we can't look back now, but we have to look through the windshield. Yes, we took appropriate action given where the job numbers are now. So we know they've been acting on bad data for some time. It's not a surprise to any of us that this rate cut did take place.
So as you mentioned a minute ago,
this guy asked a couple really good questions as well. I think the answer from Jerome Powell gives us even more certainty that we have rate cuts coming.
Some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think 1/4 percentage point now is going to arrest that?
Well, I hadn't say that I thought 1/4 point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? Mm-hmm. And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minority unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all this together and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate
That's
cut.
the part right
But
here.
the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
So the rate path. So obviously we've seen the markets, they had already baked in this quarter point hike. We're now starting to see them price in additional rate cuts. Sorry, not rate hike, rate cuts. And that's what we're seeing right now. We're seeing that now there's a lot more certainty around more rate cuts. The market is pricing that in. And Jerome Powell basically saying there, hey, yes, more rate cuts are coming. This next question talking about the consumer spending, which we talked about yesterday, and the AI boom.
The growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate.
There's been some debate lately on whether AI is already
and of course, what he's talking about here is what we talked about on the show yesterday, which is that the top 10% of income distribution is behind 49.2% of consumer spending right now. So the wealthy are absolutely propping up consumer spending. You also have, the top 10% owning 88% of the stock market. So the wealth gap has widened. Obviously, the stock market has been propped up, but all it takes is a couple of negative events to spook the markets and cause a sell-off. So we got to hope that holds off. Right now, obviously, markets are surging. There's a lot of catalysts lining up after that. I'm not too concerned about it right now, but I think it is important to note those risks. This last question, and then we'll move on to the crypto stuff. This is a really, really interesting question around tariffs and inflation. What was expected versus what they're seeing? And I say it's interesting because this is stuff we've been talking about a lot. A lot of economists did not predict this would be the case. Going through the numbers on the live streams for the last few months is something we have talked about and we've expected, though.
To affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story.
Let's see. There it is.
Up in inflation.
It is.
What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is, it's very clear that there's some pass-through.
Aha. Ha. So, okay. This whole year, all the economists have been saying, we're going to see CPI get passed through. We're going to see all this inflation to the consumer. But what have we been talking about? As much as they would want to pass that on, they can't. Okay, so we're not seeing the inflation. And I think this is a really interesting dynamic, because let's say that the tariffs were causing inflation. They wouldn't be able to cut rates if we saw like massive inflation. But what we're seeing right now, and I'm not saying this some 4D chess by the Trump administration. I think Scott Bessen's very smart, but I'm not sure that's their intention. But what we're seeing is that it's not being passed on to the consumer. Okay, the companies, the exporting companies are eating some of it. The importers are eating a fair amount of it, though. We're seeing only 0.3 to 0.4% of that inflation caused by the tariffs. This is exactly in line with what we saw with that interview of Scott Bessent and Tucker Carlson earlier this year, the MIT report that came out from the tariffs in Trump's first presidency. There's only a 0.4% increase one time. So this is exactly what we're seeing again. And what I think we're also seeing is, if these companies are having to eat some of the tariffs, well, it's hitting their margins. So what do they have to do? I think that's where we're seeing layoffs, when we're seeing, unfortunately, instead of inflation, we're seeing the job market weaken because of the tariffs. So it is absolutely having that impact. But that is also forcing now the Fed to cut rates. So the tariffs are weakening the job market, not really having an impact on inflation. It is having that outcome that the current administration wanted, which was to cut rates. Now, the question is this going to all blow up, right? Because if the job market gets too bad too quickly, that could end up crashing and burning everything, right? So now I think it is in the Fed's hands. 2 more rate cuts, it sounds like, at least this year. We'll have to keep an eye on the numbers from this point forward. The other big thing that we need to pay attention to here is the 10 and the 30 year, obviously. So we saw about a month ago, after all the job reports came out and we knew that they were going to be cutting rates, we've seen things kind of tick down leading up to this decision. But now we're seeing it start to tick back up again. And that is not what we want. We do not want the 10 and the 30 year to start moving back up, because that could obviously mean the Fed is losing control of the long-term yields. That's not good. So we need to see that stay in check. But all things considered, things seem to be on a pretty good path, at least for Q4, to stay on track and be the quarter that we've all been hoping for. If we take a look at the markets here, we have Bitcoin sitting at 117,000, obviously rallying pretty nicely today. We're seeing the same thing out of Ethereum at 45.92. Solana, though, has really been the big winner recently. And if you look at, since we started talking about it about a month back, a little bit over a month ago, we're up, almost 38%. So Solana's been absolutely crushing it. And there's still a ton of catalysts that are coming, guys. We're going to talk about a couple of those today, why I think the spot ETFs are going to happen sooner than we expected, given some of the changes the SEC announced yesterday. Also, going to dig into the treasury plays, right? The digital asset treasuries. Do they make sense? What are we seeing as far as the valuations of them? And does it make sense just to wait and get into some of these, spot ETFs potentially? So I'm going to break down the differences there. But this news came out today. There's a Solana digital asset treasury announced by the UAE. So guys, we're seeing these like every single day. It feels like multiple a week at least. And you have 300 million now in Solana purchases coming out of this one. So massive buys on Solana. You also have a lot of that supply that's, staked right now. So these buys are going to really have an impact on the price. And again, I've been saying this for a while, but I do expect Solana to have a new all-time high by the end of this year. I know there's people calling for like $1,000, $2,000 Solana, maybe eventually. I don't see that this year. I could be wrong. Hopefully I'm wrong. But I do think that we could see new all-time highs. But talking about the treasuries, we looked at this yesterday, looking at the fully diluted MNAV. So this is, of course, the premium that these are trading at. Let's load this up again here. They update this every 6 hours. So I'm going to see what we've seen, what changes we've seen here, and specifically Solana. Yeah, here. Here we go. So we have seen some of these fully diluted MNAVs move up. UpXT was at a 1.18 yesterday. And that was what I was saying. It was an outlier compared to the rest. So in my opinion, I was like, okay, it's at 1.18. That was due for a swing up. Forward Industries here was sitting at a much higher, is up over 2 yesterday. And to me, I was like, well, that is not something I want to get exposure to. I'm starting to look really at these fully diluted MNAVs to see when is the good entry points and when is it good to fade and kind of wait for them to come back down to earth. And UpXT was obviously, in my opinion, was a good play yesterday. And what did we see today with the Solana price action? Well, Solana was up today. Let's see, what was it up on the day? Barely. It was up just over, right around 1% on the day by the time that everything closed. And UpXT, which had the lowest of the fully diluted MNAVs and by comparison, very undervalued, is up 12% on the day. So I think there is some credence to this, getting into some of these treasury plays when the premium is a lot lower. Obviously, that makes sense, right? Some of the other ones that were higher, though, like we saw DeFi Development Corp's another big one, pretty flat on the day, but that was, a much higher diluted MNAV. I want to say, let's see, what was it yesterday? I think it was like 1.4 yesterday. The one that was the highest, though, and I think this obviously shows to avoid at least the ones that have a really high fully diluted MNAV. Forward Industries on a day when Solana was having a pretty decent day, down 6% on the day. So, again, these treasury plays, I'm going to keep tracking them, and I'm going to keep tracking the fully diluted MNAV against their price action and the underlying asset. I got a question on why do they have a premium at all? I thought it was a good question. I did some digging on this because ultimately, like, why not just buy the asset itself? Is there a reason that they have a premium at all? Well, for one, it does say it's access to discounted assets. So some of these companies may acquire Solana and other tokens at a discount through private placements. It said that they are staking yields. So I think most of these are getting around 7% by staking Solana. So that makes sense that you'd have a premium for that. It says that they can generate additional non-dilutive returns by participating in DeFi protocols. So potentially there's something there. Some of these companies also have an actual business. Most of them don't. I feel like they're just like dead companies that they utilize for these treasuries. Some of them actually do have other revenue streams. There's talking about the premium could be influenced by leadership, brand reputation. Look at what Tom Lee has done, right, to create that premium, to be out there in front of mainstream media and get people to buy. So I think there are some reasons why you could see a premium. The question is, how much of a premium makes sense and what will we see over time? And I think that's what we have to really track here, and whether or not it's worth it to look at these treasury companies. You're seeing some of them are actually, some of the Ethereum ones are trading at a hefty discount. You look down here, like SharpLink is at 0.98. I mean, that's actually at a discount. This one's at 0.5. So are we going to see these things come down to earth? I think we will. I think we could see them fall more in line with whatever staking yield they're getting. And I think the notable ones that have a really good figurehead that are out there, in the media talking, those are the ones that are probably going to do well. And we could probably, wouldn't be surprised if we start seeing some acquisitions from some of the bigger ones of the ones that are kind of flailing and acquiring those assets over time. So, for me, I am looking to still get some exposure on some of these. I have some exposure to the Solana ones. If you can front run potentially the spot ETFs, but the other option here is that you just invest in the actual spot ETF itself. And if you look at the Rex Osprey one on Solana, this thing has tracked the price of Solana quite well. Okay, so if you look at over the month, 31.43%. Solana by comparison is about 38%. So just getting into the staking ETF, this Rex Osprey one, you would have basically tracked with Solana over the last month at 31%. A lot of these digital asset treasuries were trading at such a high premium, like 2. Those have come down to earth and have not really performed nearly as well as Solana has. Some of them are actually down. So these Osprey Sol ETFs, I started wondering, okay, so what sets them apart from your spot ETFs that have been waiting for approval? Went down a little bit of a rabbit hole here, and I think it helps explain the changes the SEC made last night. So it's absolutely worth covering. It says here in this article, crypto firms may have found a way to fast track spot crypto ETF applications. That's how this Rex Osprey Solana ETF got approved. So it says that they're using this 1940 Act for an expedited approval of 75 days instead of 240 under the Securities Act of 1933. So the Securities Act of 1933 is what the Bitcoin and Ethereum ETFs that have been approved, that's what they used, the Securities Act of 1933. It took them forever, right? This Rex Osprey one is using what's called the 40 Act. So the 40 Act, it is different, requires a diversified portfolio, reducing risk and impact of single asset failing. So in this case, this Rex Osprey one for Solana, right? What they're doing is they're funding it with 80% of the underlying asset plus cash, treasuries, and derivatives. So that's why when you saw Solana make like a 38% move, the Rex Osprey one did a 31% move because 20% of that was sitting in cash. But by doing that, they got faster approval versus all these other ETFs that are sitting there waiting for approval right now because they're going through, this longer Securities Act of 1933 process. So again, 75 days versus 240 days. So it makes it a lot faster. And it's worth noting that there are 2 other Rex Osprey that are using the same type of ETF. We have XRP and Dogecoin, or I think they launched today, actually. So it's worth taking a look at those potentially and maybe front running because, unless they have some digital asset treasuries that are available at really low, fully diluted MNAVs, you're probably better off just tracking the asset itself. Of course, you can buy the underlying asset, but if you have like a retirement account or something like that of that nature, you want to get exposure through that. This is the way to do it. But huge freaking game changer happened last night. Okay. And this is what the SEC dropped. They basically made it so that the crypto ETFs can now be fast tracked. And it's going to be more in line with that, the Rule 40. So it says here that announced the approved generic listing approvals for commodity-based exchange-traded products, fast-tracking the approval of crypto funds. It has eliminated the need for individual approvals under section of that 1934 Act that we just talked about. So they removed those barriers. Now these can be fast-tracked. So there's no longer the Rex Osprey. That's been kind of the workaround. They are now kind of putting them on even footing, if you will. says this streamlined approach is expected to shorten launch timelines, cut administrative costs, and make more cryptocurrencies available to investors in an ETF wrapper. Okay, so we were wondering, hey, do we need that clarity bill to pass? Like, what's going on here? It sounds like with this change, we could see a lot of these that have been delayed start getting approved pretty quickly here. Solana has some big ones coming up in mid-October, by the way. But in particular, these are the assets, guys, that we can expect to come up in these spot ETFs after this change. You have Bitcoin, Dogecoin, Solana Litecoin, Chainlink, Stellar, Avalanche. Talk more about that in a minute. Shiba, Polkadot, Hedera, and you have Cardano and XRP will soon qualify as well. So this is a huge freaking game changer because the timeline was very unknown here. And the concern was that, if the clarity bill didn't get passed in time, because as we know, I've covered this, we have the budget issue coming up, and that is going to take precedent. We are going to see the clarity bill get put on the back burner. The concern was that these spot ETFs would get pushed out and pushed out and pushed out. This opens the door for them to get approved. And that means that Q4 is going to be fucking amazing. That is what that means, guys. Talking about Avalanche, by the way, man, we've been covering it quite a bit. It's actually done better over the last month than Solana, up 54%. These are obviously the two we've been tracking pretty closely. There's some major catalysts coming on with Avalanche, guys. We have PayPal is launching its official stablecoin on AVAX, other chains as well, but AVAX is one of the ones they've chosen. But we also have South Korea launching their first ever stablecoin on Avalanche. But it's not just that, guys. We have Toyota, FIFA. We got all these ETFs coming. We got the $1 billion digital asset treasury. We'll talk about that in a minute here. So the next thing I'm going to talk about. But guys, the catalysts for Avalanche are lining up. So do you want to get the digital asset treasury? Do you just want to buy the underlying asset? Do you want to, get exposure through the ETFs? The spot ETFs are coming. The digital asset treasuries, though, the reason why I think this is very interesting is because we talked about this. They have one that they've announced where they're going to be able to buy AVAX tokens at a discounted price from the foundation. In particular, there's a $500 million raise through Hivemind Capital. Okay. So my good friend Tyler did some digging. We've been looking around. I was like, man, I'm trying to find out what this could possibly be. Well, we found this filing, $500 million of common equity and warrants. Hivemind Capital is tied to it. It's this Reserve One. Okay. You dig a little bit further here. Reserve One is expected to get a listing as ROAN in Q4 of 2025. Could that be the AVAX digital asset treasury that's going to be getting discounted AVAX? I don't know, but there are certainly some links, guys. And that would be, if you could front run that somehow, that would be absolutely massive. We'll see. We'll see if that's the one. But either way, guys, I cannot tell you how bullish I am on Solana and DePIN with Solana. We talked about that yesterday, and Avalanche. But all of these, now that we can get the fast tracking these spot ETFs with that change by the SEC, man, we are ready for fireworks in Q4. Let's go. Let's talk about the DePIN side of this, though. Guys, we have some projects pumping. The Sana going absolutely bananas. Woo! You guys remember this? This was only 2 weeks ago, if you can believe it. The Sana sitting at a $21.95 million market cap. You know what this thing got up to? Like $7 in spring of 2024. These DePIN projects built on Solana, if we see these two catalysts, the market structure bill, we see the spot ETFs get approved, we see the institutional capital flowing into Solana. I think these GPU projects, you have Scott Bessent, the freaking Treasury Secretary, saying, hey, we need to look at decentralized compute projects. Like, we missing something here? I don't like, come on. It just seems like, these projects should absolutely go ballistic. So Nosana, very far down from where it was. I mean, you were looking for people looking for a good buy, a good entry point. Like, I don't know how much longer you want to wait. Well, where are we at 2 weeks later, guys? Up over 100%. We were at what, 45 cents then? That was 2 weeks ago. That's how quickly things move in this space. Got to be hopping on top of these opportunities. I still think there's massive opportunities in the GPU side, but something we talked about yesterday, robotics. Talked about it on Crypto Empress's space today too. We had a great conversation there. Crypto Empress, she's awesome. If you don't follow her, make sure to follow her, man. This is Jensen Huang talking about how big of an opportunity robotics is. I know I covered this yesterday, but in case you weren't here, I'm not going to spend too much time on this, but self-driving vehicles are the big opportunity. Okay. Well, what do we have here? Waymo. Waymo's making waves, guys. Massive opportunity. Well, what do we have here? We have Aoki. Aoki's been on quite a run. This is one of the ones I'm very bullish on, built on Base. Check out this video from their CEO. Share this here.
Beijing is a very big city. In fact, it's so big that there are more cars on the road in Beijing than there are people in Los Angeles, right? And the average commute by car is 2 hours. So if you do a quick back of the napkin calculation, you find that roughly the time it took to build the pyramids are lost in Beijing traffic every single week, right? Crazy, right? Yeah. So, thinking back to Naval's blog post, how big is the economic opportunity to get self-driving cars to coordinate with each other, not just drive autonomously, but communicate with other vehicles on the road, communicate with security cameras, be able to check, like, do I need to slow down if I go around this corner? Is someone crossing the road right now? Like, all of these things that are in theory possible for an AI to do that a human couldn't do. To be clearly a multi-trillion-dollar opportunity, right? Another way to think about it is 70% of the world's GDP is still tied to physical locations and physical labor. So the leap from like agentic AI to physical AI is an automatic 3x increase on the TAM of AI.
Whoa, multi-trillion-dollar industry. 3x TAM to AI. Robotics. Aoki is set to freaking explode. It already kind of has started, guys. The big question is like, we're gonna see any pullbacks on the way? But look at this freaking chart, man. Up 170% in the last month. Fuck. Look at GeoNet. GeoNet's out here doing things. Up 10%. Still a long way to go, in my opinion. I think GeoNet is severely undervalued, in my opinion. Rover exchange listing coming up in a few days. Man, it's had a nice rebound since we covered it back here. I did add here. I added more yesterday, though, man. I'm going to keep adding more to Rover. I'm getting really big early Hivemapper vibes here, guys, because you guys remember Honey went up like a 30x. It was very similar timing where none of the employer investor tokens had unlocked yet. There weren't that many tokens in circulation. We had this catalyst here where we have Solana, DeepN, robotics all coming together. Shoot, man. I think that Rover could, in the first exchange listing coming, granted, it's not like Coinbase, though, that's what Hivemapper had. I do think that Rover can run. I really do. Speaking of Hivemapper, though, okay, token price action has been really dog shit. I think that a big part of that is that they've had so much dilution. I think it's a solid project still, but they had so many tokens go out to investors in, their team over the last 2 years. The good news here is that that dilution is pretty much finished at this point, so you don't have to worry about any massive amount of token unlocks moving forward. The problem, though, is that I think we're having this huge sell wall, kind of like what Helium was talking about, how they had to buy out one of their early investors because they had all these tokens that they kept selling on Coinbase. I think we're seeing something similar here, guys, where one of the maybe multiple early investors are just, anytime we have a pump in honey, they're just selling the shit out of their tokens. So it could take some time to break through that. I don't think Ariel is doing it, the CEO, but I think that they certainly have some investors that are. So that, to me, limits some of the upside in the short term for Hivemapper. I think it is hitting those narratives, though. I mean, they've got several Web2 customers. They are hitting the training of autonomous vehicles. They're hitting the DePIN narrative on Solana. Like, they have all great things going. But I think they've got to get through those sellers before we can see any massive pumps. Question is, when will that happen? We've seen a lot of selling, obviously, that's beaten this thing down. So I do think it is a little bit mispriced right now, and I think there's brighter times ahead. I just don't know how long that's going to take to exhaust those sellers because there's been so much dilution. That said, though, I mean, they are continuing to make moves here, guys. The BLTE reduced its uploads by 97%, so it is doing a really good job of finding the data that's valuable. This is obviously a big deal because the sell plans that are necessary are impacted by this. If you don't have to upload as much data, that's really a good thing. And as long as it's not missing valuable data, right? And we have a 5 Mile Trucker. He posted about how after the recent MIPs, he's seen a huge increase in his rewards. So, as more of these ship out and as we see global coverage increase, rewards should continue to increase. I think the only thing, again, holding it back is that we need to exhaust those sellers because of all the dilution they've had. And that is why, personally, in the short term at least, I think that Rover has more upside from percentage standpoint. Obviously, Hivemapper is well far and beyond what Rover is doing today in their customer announcements. But I think from an investment standpoint in the short term, I still prefer Rover just because of the market cap it's at currently. Another one I'll bring up because talking about robotics, one that's been moving a lot that I think could continue moving. And I know a lot of people are huge fans of this project, and that's Peak, guys. Peak is hitting that robotics narrative as well. And I think it could continue to run. Not to say we couldn't have a pullback. Look at this chart. I mean, this thing over the last month has just been exploding, but it does hit that narrative also. Okay. So if you guys have any projects and like robotics projects that I'm not covering, put them in the comments, man. Because I would like to dig into this more. I think I really do think it's like going to be the AI agent alpha from that we saw last year, leading into Q4. And I think right now, the way things are shaping up, not to say we couldn't have any pullbacks before things really take off, but I don't know that we will at this point. I think Q4 is shaping up to be absolutely freaking massive. Okay. And the spot ETF thing, I don't think enough people are talking about this. That is one of the biggest catalysts that we could have asked for. Because if we had, held off, then we could have risked potentially, if these spot ETFs don't get approved in October or this year, we could run the risk of, the job market falling apart and the economy falling apart before we have the alt season we're hoping for. If this moves up that timeline, that's a big freaking deal, man. Okay. So that is why I'm so excited. And if you don't think that alt season is coming, okay, if you don't think we're going to see an alt season, check this shit out. So this title, the ETF Masters, they launch, manage, and grow your ETF. Take a look at this ETF that I found today that was that they applied for. So Title Trust here. And this was, again, September 18th, today. A daily alt season, 2x daily alt season crypto ETF. Guys, it's coming. It's coming. I'm excited. I hope you guys have been paying attention and digging in. I know it's been boring. It's been brutal this whole year. But I think things could turn. The tides are turning. I really do believe so. I am freaking excited. And guess what, guys? We are in 15 minutes hopping on the DePIN happy hour. So join us over there. Be joined by Brian, Quez. We got Tyler and William. we'll have a nice discussion around DePIN. We'll probably talk about some of the stuff I covered here, but we'll have a great discussion over there. So hope to see you guys there. If you don't follow that account, make sure to follow it, man. Make sure to follow. They got my picture up there now too. Freaking awesome. Oh, by the way, I put up this post about, let's see here, about helium that's been getting some traction. I don't know if I'm gonna be able to find it on here. Oh yeah, and watch this too. You got the 375 AI interview with Tyler and Harry, man. That's another project. That thing's gonna freaking explode, man, for sure. Really excited about 375 AI. There's some big token launches coming in Q4. Can you imagine all this stuff's lining up for DePIN? You know, I showed yesterday how Solana has been really pushing DePIN, but man, we could have such a big Q4. I mean, it could be such an exciting time. Everything we've been waiting for, right? Here we go. This is the post I was talking about. Got retweeted by Helium, but man, the fundamentals for Solana, spot ETFs coming. Clarity Act should come by the end of the year. And then you have the Solana Foundation putting a DePIN section on their website, man. Whew. It's coming together. It's coming together. That's what I got for you guys today. Obviously, I'm going to be hopping over to the happy hour here in a minute. Oh, I hope you guys are ready. I'm ready. I'm ready. It's been a long year, but we've been consistent. We've been here every single day. I will be back with you guys tomorrow. Appreciate each and every one of you. Please make sure to like, subscribe to the channel if you haven't already, and share on X if you haven't already as well. Peace.